Welcome to this explainer. Look, if you're trying to build long-term wealth, you've absolutely crossed paths with the two tools we're talking about today. But the debate between them has honestly reached a fever pitch lately. On one side, we have the incredible legacy of Jack Bogle's traditional index funds, which completely revolutionized retail investing decades ago. And on the other, well, you've got the absolute explosion of ETFs, which have completely transformed the modern financial landscape with their incredible flexibility. So today, we're going to dive deep, we're unpacking the mechanics, laying out the data, and pitting them against each other in the ultimate wrapper showdown.
Here's our roadmap to untangle all of this today. First, the great investing debate. Then, decoding the index fund. After that, enter the ETF, followed by the head-to-head matchup, and finally, choosing your investment wrapper.
Let's jump right into Section 1, the great investing debate.
Okay, have you ever heard a traditional financial advisor confidently say, just invest in an index fund, while some modern personal finance blogger vehemently tells you to buy an ETF? You know, it creates a tremendous amount of confusion for everyday investors, because at first glance, they sound like the exact same thing. Both contract identical benchmarks like the S&P 500, both are universally beloved for being incredibly low cost, and they are both undisputed favorites for long-term compounding. And yet, they've cultivated entirely different subcultures. One group acts as the total set-it-and-forget-it purists, while the other leans heavily into modern, app-based agility. So what is the actual structural difference under the hood here? And more importantly, does it genuinely impact your path to financial independence?
Moving on to Section 2, decoding the index fund.
So let's start with our first contender. What exactly is an index fund? Fundamentally, it's a mutual fund designed to strictly match the performance of a specific market index. That could be the S&P 500, the NASDAQ 100, or the total U.S. stock market. Instead of paying exorbitant fees to some active manager who tries to beat the market by guessing which stocks will win, which is incredibly hard to do, by the way, this fund takes a purely mathematical approach. It aggregates cash from millions of everyday investors, pools it all together, and systematically purchases the underlying block of stocks to directly mirror the index. It just completely removes the bloated expense of active management and replaces it with sheer calculated replication.
To really understand how this replication works in practice, we have to talk about market cap weighting. It's actually pretty simple. If a massive company like Apple represents, say, roughly 7% of the total value of the S&P 500, the index fund doesn't overthink it. It simply allocates exactly 7% of its pooled assets directly into Apple stock. The other 93% is distributed proportionally among the remaining 499 companies. This means when you buy a single share of an index fund, you are essentially buying a microscopic, prepackaged slice of the broader economy, automatically weighted toward the market's biggest winners.
Because they strip away the need for those highly paid stock pickers, these funds maintain unbelievably low internal costs. But honestly, their true superpower is in their structural accounting. You see, index funds process all of their trades at the end of the day. That makes it effortless to invest highly specific, totally irregular dollar amounts. Think about it. When your biweekly payroll automatically deducts some weird amount, say $137.42 into your 401k, the index mutual fund can seamlessly digest that exact dollar amount into fractional ownership. That specific structural advantage is exactly why index funds form the bedrock of almost every automated retirement system in America today.
All right, let's pivot to Section 3, enter the ETF.
Now we introduce the challenger, the ETF, which stands for Exchange Traded Fund. Historically, this was created for a very specific purpose, to give mutual funds the rapid liquidity of individual stocks. Much like our previous contender, an ETF can track the exact same market indexes and hold the exact same proportionate shares of companies. The core difference, the structural innovation that separates the two, lies entirely in how you, the end user, buy and sell it. As the name states, it trades directly on the stock exchange.
Because of that structural difference, if the stock market is open, say it's 11:30 in the morning, you can purchase an ETF instantly at the current live market price. The price fluctuates every single second of the trading day. Now, this real-time trading, well, actually it's a bit of a double-edged sword. On one hand, it's a massive draw for self-directed investors who really want that agility to buy market dips intraday. But on the other hand, from a behavioral finance perspective, having live flashing prices right there in your pocket, that can often tempt long-term investors into the dangerous trap of emotional day trading, making them completely abandon their boring yet highly effective compounding strategies.
This brings us nicely to Section 4, the head-to-head matchup. Let's literally pit the mechanics of these two against each other, starting with trading execution.
Say you submit a buy order for a traditional index fund at 10 a.m. Your order simply sits in a queue. It just waits there until 4 p.m. when the market officially closes, and all the day's math is settled into a single daily price called the net asset value, or NAV. Everyone who bought that day gets the exact same NAV price. ETFs, though, they throw that waiting game completely out the window. If you hit buy at 10 a.m., your order crosses the bid/ask spread and executes immediately. You own it right then and there, and your price reflects the market sentiment of that exact second.
Now, when we look at taxes, ETFs pull off a remarkably clever trick of financial engineering. It's a process called in-kind creation and redemption. Look, you don't need a finance degree to understand it, but the gist is powerful. When an ETF needs to offload shares, it simply swaps baskets of underlying stocks with authorized participants rather than selling them for cash on the open market. Because they aren't selling for cash, they don't trigger massive taxable events. Traditional index funds, however, occasionally have to sell underlying assets to pay out investors who are leaving the fund, and that can trigger capital gains distributions for everyone else still holding the fund. So if you're using a standard non-retirement brokerage account, the ETF is structurally a far more tax-efficient engine.
So, pulling this data together, when we weigh minimums, automation, and taxes, a very clear divide emerges in how we build wealth today. Historically, traditional index funds demanded strict minimum investments. We're talking sometimes upwards of $3,000 just to get your foot in the door, though thankfully many brokerages are finally eliminating those barriers. ETFs, however, radically democratized the starting line. By trading like stocks, you could always buy in for the price of just one single share. And today, fractional shares mean you can literally start with $5. Yet traditional index funds fiercely defend their territory when it comes to behavioral discipline. Their ability to pull a perfectly precise dollar amount from your bank account every single month, totally on autopilot without you ever checking an app, honestly, that is a wealth-building superpower.
But here's the absolute best news. The greatest victory for you, the modern investor, regardless of which side of the aisle you choose, is the absolute collapse in cost. Remember when Jack Bogle launched the first retail index fund? Traditional management fees were literally eating investors alive. Today, many broad market options across both traditional index funds and ETFs charge phenomenal annual expense ratios of less than 0.10%. To put that into perspective, a 0.10% fee means that on a $10,000 investment, you are paying a mere $10 a year for professional-grade, self-cleansing market replication. That keeps your capital exactly where it belongs, in your own portfolio, accelerating your compounding effect over decades.
And finally, Section 5, choosing your investment wrapper. So, what does this all mean for you? Well, the most profound realization you can have as an investor is that obsessing over the battle between ETFs and index funds is usually just a distraction from the actual goal, saving more money. An S&P 500 index fund and an S&P 500 ETF hold the exact same assets in the exact same proportions, generating effectively the exact same returns. It's literally the exact same delicious candy, just wrapped in slightly different packaging. The underlying economic engine driving your wealth is identical. Ultimately, your choice shouldn't be driven by this fear of making the wrong technical decision. It should be driven by intimately knowing your own psychological investing style. Both structures are magnificent, low-cost engines for diversification. If you thrive on flexibility, if you demand real-time trade execution, and if you are prioritizing tax efficiency in a standard brokerage account, you should for sure lean toward the ETF. But if you're a long-term investor who knows that staring at flashing market prices is just going to make you anxious, and you simply want a completely automated, robotic strategy where your money goes to work behind the scenes, the traditional index fund is your undisputed champion.
Because at the end of the day, your long-term financial independence depends infinitely more on building a relentless habit of investing than it does on agonizing over the specific vehicle. The goal is to stop researching, pick your engine, and let compounding take the wheel. So, which of these two paths will you confidently commit to today and consistently stick with for the years, not just weeks to come? Thanks for joining me for this explainer, and keep investing.